This rally is going to run out of steam in the next couple of weeks.
It wouldn't surprise me if we took a pause.
We've seen such a strong rally. It's natural for some of the steam to come off of that.
I think it's very possible we could have a pretty painful drawdown in the first half.
You've been bullish when others have not been. You're also in the camp that August could be tricky.
Yes, yeah, I think August is tricky because, as Bob mentioned, people are on vacation, so it's more vulnerable to sort of shocks. And I think we're in a period where we're going to be nervous about good news. We don't want a good jobs report, or we don't want strong PMIs, because that brings September hike back on the table along with the 10-year where it is. I think it's very possible we could have a pretty painful drawdown in the first half.
Now that you see strategists sort of bumping up their price targets for year end, Bob was talking about the extreme bullishness now. Does that make you just worry?
Yeah, I think it's a bad sign. We know the strategists tend to reflect the buy side. And all these price target hikes are chases of a market that's already extended. And then we have August, which is seasonally kind of bumpy. And I am kind of worried that we're going to get some good jobs data, like strong job numbers. People are going to start thinking September and higher rates. Oil's already rising. It feels like it could be pretty messy. All these things I mentioned are just tactical because I think the second half is going to be really strong. But to me, it's a broadening of the market. You know, it's more about the industrials really responding to the PMIs bottoming, and it's energy reflecting the rise in oil. And so I think it's a broader market, but we could still finish, over 4,800.
Do you worry about overall valuation levels?
The reason I'm less worried about valuation is so many clients tell us valuation's a problem. And so when you know that that's already top of mind for clients and they're already being selective, I think the valuation problem tends to be in the mega cap, and the, X the top FANG, we're at 16 times. That's pretty reasonable for a 4% 10-year. If someone's making a case for FANG, imagine someone's thesis is don't buy it because it's expensive. That you would have avoided it for 20 years. So you can't take FANG and say that's a reason not to own it because it's expensive. They've always been. But the rest of the market is pretty reasonable. So I think there's a reason to own both.
But if valuation is not a worry, then 4% shouldn't be a worry either.
The 10-year averaged 5.3% from 1990 to 2007, and the market's total PE was 18 times. We're at 16 times ex-FANG, so there's still room for plenty of multiple expansion. And, it's a good environment for companies when the bogey's 4% on 10-year because it also limits competition, right? Capital formation's slow, so the dominant companies actually make more money.
Are we in for a decline of the markets based on historicals, or is there something else that could push this market lower or maybe keep the rally going?
It wouldn't surprise me if we took a pause, but I'm encouraged by the economic data that we're seeing and how that's translating into earnings being a little bit better than expected. So if you look at the economic data, we got the GDP numbers last week, 2.4 versus 2% in the first quarter. So an acceleration, right? Led by the consumer. We've talked about the consumer endlessly all year. Supported by jobs, supported by wages, and even the JOLTS number today. I know people are kind of encouraged because it came down. You still have 1.6 jobs available for one unemployed person. So consumer is doing just fine. I think will continue. Manufacturing, it's a little bit different, right? It's a little dicey, but I think the PMIs are bottoming at this point, especially on the regional series. So I think the manufacturing side of the economy certainly could be the surprise in the second half of the year as it kind of gets a little bit better. Durable goods really encouraging last week as well. And at the same time, we all know that inflation is coming down. So all of this wrapped up is leading to a little bit better than expected earnings and a broadening of the market. And if you look at some of the industrials, for example, they've really been stellar. They're putting up about 7-8% growth. The financials are put up about 8%. Banks put up 19% earnings growth. So it's not just tech, and I'm encouraged by that. And if we can continue to see the broadening in the marketplace, I actually think that might carry us higher, these other industries. So I'm encouraged.
You could take some money out of the market. I do not think it's wise to get wildly out of the market. I've raised some cash recently. I've got about 7%. Steph, you made a great point that another way to deal with that is maybe take some money from the high-flying tech winners and put it into some of the things that you and I have liked for quite some time, the more cyclicals, financials, industrials, materials, and energy, and kind of hide out there. Let me be clear that what I'm saying is not scientific, okay? There's nothing, I can't prove this to you. This is just experience that probably, this rally is going to run out of steam in the next couple of weeks. Consider, Frank and everybody, consider the next week you got the CPI. What if, I'm not saying it will happen, but what if it has a 2 handle on the headline, right? That would indicate that really the Fed should be done. I think the market's priced that in. I think it's hard to get more good news into this market. It does not mean sell all your stocks and, head for the hills. It just means be a little tactical here. in the long run, things look very bright. You know, these 3 infrastructure bills that we've had over the last 2 years, they really don't start hitting until next year through 2026. Those are going to be powerful economic drivers. So you don't want to really be out of this market, but you can be a little tactical around the edges.
You always have to look at history and find out what investors typically do after a big run up like this. And to Jim's point, we've seen such a strong rally. It's natural for some of the steam to come off of that. But I think what we're going to see, and what a lot of the minds have changed to come to believe, is that maybe an Armageddon type recession is not in the cards. Maybe it's a softer recession. Maybe it's some kind of contraction that's not as painful. And even better than that, maybe it's not going to hit every single sector at the same time, because tech has already gone through its pain, gone through its cost-cutting cycle. And then this big run up in price, perhaps leading a little bit and getting ahead of itself. But now the question is, does tech have to move down to meet the rest of the market, or will the rest of the market come up to meet it, the cyclical sectors and the stuff that has been unloved? If July repeats and extends into August and into fall, then it sounds like the cyclical sectors and some small caps will catch up, which, to Steph's point, broadening out is a strong indicator. I think we're still not entirely sure, though, what these lagging effects of the tightening cycle will be. So I'm not ready to jump in and say, okay, full steam ahead, but it does look stronger than I expected.